Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favoriteest podcast on life insurance.
That's right. Favoriteest.
Got to mix it up just a little tiny bit.
A little flourish in there.
Throw a couple things in there. A little zing for the day.
Yeah.
Keeps them excited.
Well, and we're gonna stick with our trend of actually talking about life insurance. So,
well, that's probably a record as far as the number in a row that we've done. We need something to happen for us to veer off the trail.
Yeah.
So,
yep. Before we get started, I would like to remind all of those listening, if you're interested in talking about a life insurance policy and or fixed annuity of any kind for your situation, you can head over to theinsuranceproblog.com, and prominently displayed in many places, you will see a button that says schedule a call, whatever. You can directly get some time on our calendar to talk to us, and we can go through your situation, find out what's on your mind, and see if we can help.
I'm scheduling a call right now.
Oh,
it was that easy.
Yeah. There'll also be a link in the podcast description if you have the ability to do that. I will claim ignorance in that I never really know how to do that personally, but I do put them in there. So,
hey, either they'll schedule something or they won't, and we'll just sit around wondering why we're not talking to anybody.
That's right. That's right.
But come on over. Right. We'll be happy to talk.
That's right. So what's on the agenda today?
We're going to talk about indexed universal life insurance in the context of how it would compare from a rate of return perspective to whole life insurance, because our thesis is indexed universal life insurance should long term have a better rate of return than whole life insurance would on cash value.
Yeah.
Now, that's a very blanket statement. I'm not saying that for every circumstance that therefore means indexed universal life insurance is the right product for you and whole life insurance is the wrong product for you. There is many shades of gray to this, but in general, we have the expectation that if we compute rate of return on cash value relative to the premiums that get paid, we should see a higher result from indexed universal life insurance. That's our long-standing theory. The whole idea is the indexing aspect of universal life insurance presents two things. One, this higher per year potential interest payment than you would get from whole life guaranteed interest and dividends.
Right.
So higher potential being the emphasis there. But also comes with the risk that there could be years where you get bupkis.
Right. You get zero.
So there is a little risk there that you're going to have some disappointing years, but you are compensated for that because of the indexing feature and the higher assumed lifetime rate of return.
Right.
Cool. Now,
and
go ahead.
I mean, this really comes from the fact that we have a decent amount of anecdotal evidence to prove our point within our own book of business.
We have binders full of in-force policies.
Yeah.
So
I didn't know you had binders.
Well, okay. I'm making a little joke of politics past.
But this is more of an in-depth study of it to posit, is that true or not?
Yes, it is. So the question that we want to tackle today is, if we expect indexed universal life insurance to perform better in terms of cash accumulation, what needs to change? What circumstance need to exist in order for us to be dubious on that notion? So we love to talk about cap rates with indexed universal life insurance. Well, we don't, but I'm figuratively speaking here. There's this discussion that, indexed universal life insurance can get you almost market-like returns. Wrong, but let's just let the sensational people have their moment here. And then there's always the caveat that the opposition party comes up with. This is but there's a cap.
Right.
So the insurance company wants you to participate in the S&P 500. That's great, but only up to maybe like 11%.
Yep.
And if the market's up 20%,
they're going to keep the difference.
Yeah, no. If the market's up 20%, there's so much you're giving up. And our argument is, look, you're not buying indexed universal life insurance because you're trying to get the 20% return of the market. because you are also giving up the possibility of the 10% down of the market.
Right.
Or whatever it is. So, okay, fine. Cap rate is what it is. The question is, how far down does the cap rate need to go in order for us to now look at this and say, ooh, I don't think that's going to work out better than whole life insurance.
Right.
That's the question.
Yeah, because the thing in the back of everyone's mind is like whole life insurance we understand is a very low risk asset, and it's going to grow, assuming it's designed properly, it's going to grow pretty systematically. It's never going to be the number on your illustration because dividends go up and down.
Mm-hmm.
But it's much more predictable.
Yeah.
And so if you can't achieve some significant advantage in the return with IUL, then what's the point in doing it?
Correct. So, because we love to create all kinds of sophisticated spreadsheets and run calculations, we did just that to try and answer what needs to change with cap rates, participation rates, spreads, because we did them all, in order to figure out at what point we would look at this and say, oh yeah, no, I would not do that over whole life insurance.
Right.
So, baseline for understanding the setup of the analysis, we're looking at 30-year scenarios. We're running them as kind of rolling tranches from 1980 through 2009 being the first one, then 1981 through 2010 being the next one, and so on until we get to 1996 through 2025.
Okay.
Because 2026 isn't over yet. We don't generally use the current year because we don't know what the end of the year result is.
Right.
So this gives us like 17 different observations, which not the largest data pool we've ever created, but it's quite a bit for us to make an inference here. We are synthesizing expenses here, basically by taking 0.5% of cash value in all years from the calculation to account for what insurance expenses would be. That's about double what we know optimally best designed index universal life insurance expenses would actually come out to, because we've done that math. We've done podcast episodes on it. It exists on the Insurance Pro blog. That one's pretty well established. So we are taking account expenses here. We're not calculating these with bonuses. So I want to bring that up because that's an important potential caveat to all of this. A number of index universal life insurance policies do provide bonuses over and above the indexing feature.
Right.
Some are better than others. This is really hard to figure out like what the average style of bonus is and how you kind of incorporate that into the analysis to figure out like the cap rate could go to this, but if the bonus is at least that gets a lot more complicated.
Yeah.
So the free resource we're giving you decided to be a little lazy on that end. Sorry.
Well, I don't think the bonus would make or break.
It's gonna
a decision for. I mean, there's not a lot of data published on the bonuses that's publicly available. So
that it's hard. Yes, it's hard to compile all of who's doing what. And the bonus, it's going to change a little bit of this, right? Like if we find out the minimum possible cap is X, just without the bonus, then the bonus possibly says that, well, it could actually go a little bit lower and we would be just fine.
Right.
But just know that bonuses do influence some of the actual results here.
Mm-hmm.
We're also in all cases assuming a zero floor.
Right.
So no 1%, no 2% minimums of anything. So not super common these days for those products to exist, but they're still in small numbers. They're around. And again, like bonuses would influence this a little bit to say that, well, actually it could be a little bit less than that and we would be just fine.
Right.
So with that said, we basically started at kind of what's average and worked our way down incrementally to find out, okay, at what point do we drive the probability of hitting an actual money-weighted rate of return with the index universal life insurance policy here that we think is at or below what we would find with a whole life insurance policy.
Right.
And running that analysis, what we discovered with cap rates is if we fall, if the cap rate is below 8%, then we cast serious doubt on the viability of the IUL policy outperforming whole life insurance.
Right.
Now, I want to call a brief timeout and make another point of clarification. That 8% number is from inception.
Right.
That's how this analysis was done.
Below 8% and stay there.
Yes. And it also means that if we started at, say, 11% and we got to 8% like 5 or 6 years later, that does not necessarily mean at that point we no longer have a chance of outperforming whole life insurance.
Right.
Just means that from
we've seen some of that before.
Yep. From the very beginning. So 8% on a 0 floor, no bonus. If the policy starts right now at 8%, you should probably just buy whole life insurance.
Right.
Because that will most likely outperform index universal life insurance. The really good news is 8% is the cap just out of the gate. That's on the extremely low end of new issue index universal life insurance right now.
Yeah. Yes, it is.
There are lots and lots of options that are significantly higher than 8% as the cap rate.
Mm-hmm.
We also wanted to look at some of the other ways that this gets done, because not every indexed universal life insurance policy is just a 0 floor up to some cap rate on their S&P 500 account. So some use a no cap option, and they have either a different participation rate or a spread.
Right.
For the uninitiated, participation rates are always part of the discussion with indexed accounts, but for a lot of them, the participation rate is 100%, which means it doesn't influence up or down the result in the movement in the index.
Right.
If we have an uncapped index, we may find the participation rate is the other variable here, and it's probably going to be less than 100% if it's an S&P 500 index account.
Right.
So whatever that participation rate is, let's say it's 70%, means we're going to take the result of the S&P 500, we're going to multiply that by the percentage, so 0.7 if it's 70%, and that becomes the interest payable on the index. So if the S&P 500 is up 10% with a 70% participation rate, that means 7% is the interest payable on the index.
Right.
If we're doing that style of index account, 0 floor, no bonus, just want to reiterate, 40% is the participation rate we need to be at in order for us to decide, no, whole life insurance will probably do better.
That's pretty low in an IUL policy.
That is very low. Now, granted, there are far, far fewer uncapped S&P 500 accounts on index universal life insurance policies than there are capped ones.
Yes.
Far fewer.
Yep, that's for sure.
But they exist. They do exist. And one of the things that helps those index accounts achieve higher overall returns is the fact that now you benefit from the years that are 20, 25, 30% years on the S&P 500.
Right. Yep. We've seen that play out too.
Mm-hmm. Mm-hmm. We have. Spreads are a slightly different way of doing an uncapped index account, where now we have movement in the index minus some kind of hard percentage. So maybe it's a 6% spread, which means if the index is up 20%, 14% becomes the interest payable on the index account. Because we're just going to deduct that 6% from whatever the calculated change is.
Right.
This analysis tells us that a 12% spread would put us in a place where we're now dubious about index universal life insurance outperforming whole life insurance.
Right.
And again, to reiterate, because I'm going to say it again, just in case somebody missed it, 0 floor, no bonus.
%12 spread's pretty high.
That is high. It's not unheard of, but it's high. And it's especially unheard of with a 0 floor situation.
Mm-hmm. Mm-hmm.
And for the uncapped ones that I'm familiar with that have a spread and have made it to 12%, they're not still there, to my knowledge.
Right.
So they may have gotten to that point at some point in their existence, but they didn't stay there.
Right.
So the other good finding here is that for a big percentage of the available indexed universal life insurance policies that are out there, designing them correctly for cash optimization, which is an entirely different discussion, but a critical first step, they all have the makings for outperforming whole life insurance.
Right. Which is nice.
Now, also, we should reiterate that this has to be the entirety of the indexed universal life insurance policy's existence. So if we started with a cap rate of 12%, for example, and we got to 8%, that doesn't mean it won't do as well as whole life insurance, and you should have bought whole life insurance.
Right.
And we should also reiterate something that you said earlier, which is cap rates can fall, but they can come back up.
Mm-hmm.
And we have seen that happen quite a bit in the past couple of years.
Yep. Very much so. When interest rates came back up, so did cap rates.
Mm-hmm. Mm-hmm.
It's almost like they're connected somehow.
A little bit. So I want to call out very specifically, because we've hinted but we've not said, this does not intend to tell people who own indexed universal life insurance, oh, my cap rate got to 7 3/4, so I guess game over for that. I should get rid of it and buy whole life insurance. That's not what we're saying. That's not what we're saying. We're really trying to drive home the fact that there is probably a long-term advantage to owning indexed universal life insurance in a lot of circumstances. Mm-hmm. And the degree to which indexed universal life insurance has to decline, if you will, in terms of potential is quite substantial in order for it to now match what we would expect coming out of whole life insurance.
Right. And that's just a match. Mm-hmm. Like, we're not talking about underperforming.
Right. Right. And there are a couple of things about universal life insurance that make it a little more capable of producing $1 of income per dollar of cash value accumulated.
Yeah.
Has nothing to do with the indexing feature and everything to do with the way universal life insurance typically qualifies as life insurance,
mm-hmm.
which allows it to be a little less expense heavy as you get into your advanced stages.
That's contrary to popular belief, Brandon.
I know it's supposed to just explode and be unmanageable and stuff, but that's the theory. It doesn't hold true. I'm sorry.
Yeah.
So, just because the rate of return matches whole life insurance doesn't mean the net benefit as an income vehicle.
You brought up something I was going to bring up earlier, but I was waiting for the right moment.
All right. Well, sorry.
No. I mean, I was just going to say, for the same premium dollar, and you may have a more eloquent way to say this, but for the same premium dollar going into whole life versus IUL, and we're talking about the same person, identical circumstances, identical rating classes, everything across the board, all things being equal, you can end up with more cash
mm-hmm.
in the IUL policy.
Right.
And that just has to do with how the policies function.
Right.
You're just not going to be able to get as much of your premium dollar to directly attribute to the cash value in a whole life policy as you will be in an IUL policy.
Yeah. Yeah. There are a few things that whole life insurance is going to mandate from you that are going to limit what goes to cash immediately and what does not.
Right.
And that's just the way that, or it's
one
of the
things structural thing. Yeah.
That is different between the two. The other thing to bring up in all of this is that these are purely analyses of S&P 500 indices.
Yeah.
And there are a lot of index products now that have more than just an S&P 500 index.
Yeah.
And so those now introduce more complexity and more opportunity.
I was going to say, they've always had more than S&P 500, but in years past, the other options weren't even worth paying attention to.
In some cases, yeah.
But that has changed over the last several years. There are more opportunities that have come online in the space as they, the companies want to be competitive. So they have become much more competitive.
Right. I would argue there's kind of two motivations there. The competitive thing, absolutely. The other thing is we got to a point years ago where insurance companies started to realize, based on everyone who's piling into index products and using the S&P 500, the options market is getting mighty expensive.
Yeah.
So if we start looking at other things that are not S&P 500, that'll save us some money on the options budget side.
Yep.
And allow us to offer higher cap rates, higher participation rates, whatever it is, as another way of addressing this. And in some cases that happened, and then other companies took note and started piling into those things, and that brought cap rates down. In some circumstances, insurance companies were capable of making some of those options proprietary to them, which helped with the options pricing. But yes, there is a desire, as much as some of the internet would like you to believe otherwise. Insurance companies don't just sit back and go, well, we did what we could, so now we just got to convince them that this thing that can't get any better is what they need to buy.
Right. Exactly.
They're very aware of their competitive positioning against all of the other things that you could put your money into. The other note here that I want to bring up, because I mentioned earlier on that we do expect in general index universal life insurance to perform better rate of return wise than whole life insurance. But there are some situations where whole life insurance is still the right answer, and it has nothing to do with your feelings about the risk profile and everything to do with your circumstances. We have noted many, many times in the past that age and time that you intend to accumulate does weigh on this decision.
Yeah. Substantially.
Now, interestingly, the impact on rate of return that age, for example, has on index universal life insurance is far less significant than for whole life insurance. Like, it kind of tends to be pretty universal.
Yeah.
Whereas whole life insurance can be a bit more impacted by the age or the amount of time you intend to put money into the whole life policy.
Right.
So there are some times when you might find the difference to be less significant between the two, depending on where you fall age-wise. And if that's something that you're very, very curious about, again, you can come to the website, schedule time, and we'll walk you through exactly what that means.
Yeah.
Versus
in general, would you say, what would be the circumstances in general? I mean, no one's going to hold you to this, but where it would look better for older, younger, one product versus the other?
So if you are younger, starting whole life insurance younger, you will achieve in general a better rate of return by the time you get to, let's say, age 65. Then if you were
paid the whole time.
Yep, correct. Versus starting at, let's say, age 50.
Right.
The rate of return will be less impressive most of the time with whole life insurance.
Yeah.
That doesn't mean it's bad. It just means there is definitely a compounding advantage to whole life insurance that materializes when you start one of those policies at, say, 30 or 35.
Right.
With index universal life insurance, again, still think that there's probably a higher rate of return calculated, but it's less impacted by age.
Right.
So the very not obvious thing is you could start index universal life insurance very young, or you could start it much, much older. And the net impact that has on calculated rate of return is less than what you'd find with whole life insurance.
Right.
But that doesn't mean I'm telling you, well, if you're younger, buy whole life insurance, not index universal life insurance. What you might discover by buying index universal life insurance so young is that compounding difference over that many more years makes index universal life insurance even more impressive, actually.
Yeah.
What I'm telling you is there are situations where you might find that if you're a bit older and you're thinking, well, maybe the time came and passed for me, index universal life insurance may still be a viable option where whole life insurance becomes far less attractive.
Right. Right.
Now all the people who bought whole life from us in their 50, 55 age range are headed to the website to schedule a call and find out why. No.
Well, the other thing you always, at older ages, especially if you plan on tapping the cash for anything, you've got to be cognizant with index universal life insurance. You always have to be aware of surrender charges. So
yes, because they can go on for a while.
Yeah.
And that may impact what you have for accessible cash. You buy an index universal life insurance policy at age 55 with the intention of starting income at age 65. It's not necessarily the case that you can't do that, but for a lot of index universal life policies, there's a possibility you will still be in the surrender period.
Right.
So doesn't mean you can't take money from it. Just means
Sure.
that what you have available to you is not all of the cash that has accumulated in the policy.
Right. Exactly.
So, to the claim that whole life insurance is better because it's better or index universal life insurance is bad because it's bad, there are things that make index universal life insurance more attractive from a rate of return perspective.
Yep.
There's really no getting around that. The real analysis that I always argue has to come up for everybody every time they try to consider which one they should buy is, do you see the difference as we project it to be enough to sway you in one direction or another? There will be more risk to index universal life insurance in terms of year over year variability to the rate of return.
Right.
But here's the difference that we see in terms of cash accumulated or the difference that we see being generatable in income. And if you look at that difference and you go, well, that's $12,000 more a year from the index universal life insurance policy, that would be cool to have.
Right.
Or you look at it and you go, oh, $12,000 isn't going to be that life-changing between the two.
Right.
So
Right.
if whole life insurance is a more consistent option, I'll just go that way.
Right.
There is no right answer on that one.
Yep.
That one is very circumstantial to the individual. And there's arguably different things that make companies that primarily engage in whole life insurance attractive for certain circumstances. There's another argument that can be made for companies that primarily engage in index universal life insurance. We get hung up in the fact that, well, the ones that are issuing whole life, usually they're mutual companies. They're very conservatively managed. The risk of them getting into financial hot water is very, very low.
Right.
True statements. The alternative argument is a lot of the companies that do index universal life insurance, they tend to have access to public capital, which means even if they did fall into some degree of trouble, they have lots and lots of various avenues they can entertain to get themselves out of that problem.
Right.
Which one's the right way? Been doing this for 20 years, it kind of comes down to it doesn't really matter. They both have options.
Yep. And we've seen both flavors perform.
Yep.
Very well. So.
Yep.
I don't put much stock in that argument.
No. A lot of people are going to do what they're most comfortable with.
Right.
So that's what it ultimately comes down to. But both have their place. We do believe there is an advantage accumulation-wise to index universal life insurance.
Yes.
We have not addressed at all today the death benefit differences.
Right.
Which was not the intention of today, but what we'll say is if death benefit is of critical importance, that very, very commonly swings things in the favor of whole life insurance.
Right.
That's just the way it goes. So, index universal life insurance has an accumulation advantage, and it's got to get a whole lot worse for it to just match what we expect out of whole life insurance.
Yep.
Now, there is another part of this that could also be true. unlikely, but a possible scenario, which is the dividend scales at whole life insurance companies increases quite dramatically from here.
Mm-hmm.
We do not see that scenario unfolding, but
we've never seen a dramatic increase.
But the probability of it happening is not zero.
Right. It'll increase dramatically over 10 years, Brandon. That's the other thing. It's so slow to do so, even if it were to change.
Mm-hmm. Mm-hmm.
It never happens all at once.
No, it does not. But it does mean that a circumstance could materialize at some point where we have to revisit this because dividend scales have increased by some highly measurable amount.
Right.
There's also a possibility that if that circumstance unfolds, there's things going on that make index universal life insurance cap rates, participation rates, etc., a lot more attractive.
Yeah. Agreed. Yeah.
And that's enough for today.
All right.
I think, unless you have something else that you want to throw in this.
I do not.
Okay. I am Brandon Roberts.
And I am Brantley Whitley.
Thanks so much for joining us. We will see you next week.